So in this video we're going to talk about risk and return, but mostly how to identify risk and to measure it. In everyday terms, risk is the probability that results of an event will differ from predicted outcome results. In financial terms, the probability that the yield from an investment is lower than expected. In other words, risk is not only about losing money. Risk is about not obtaining the yield you're looking for. If you're expecting 5% return, only getting 3, you are not getting what you bargained for. There is a risk that happens. What we're going to try to measure is that risk. Just as a reminder here, these are the equations we saw before, how to calculate the yield on an investment. And this is what we're going to look at. We're going to compare these yields to the actual yield you obtained compared to what you were expecting. Most people are risk averse. Negative feelings about risk. You want to avoid risk as much as possible. There's a trade-off between risk and return. The lower the risk, the lower the return. Trade-off, if you're willing to take a little more risk with your equity, meaning that you might not get the level of return that you're expecting. You might even get negative returns. There's a risk of that. Well, you'll be getting a higher return. What are the sources of risk? Well, different political risk, external from the company, conflicts, competition, new technologies, economic conditions generally. These are all sources that are external from the business and that will apply to every business around. Now, if the economy goes bad in a country, it's not only one company that's going to suffer, all the organizations would suffer. Internally, control and management. Can the management actually control its operations and get the dividend out? Can they actually get a return to the investor? Innovation. Can this management keep innovating? Can they bring out new products or new technologies, new processes, making it so that they do not become obsolete in the short future? Now, the biggest source of risk is time. The longer the investment periods are, the more difficult it is to predict the outcome. It's very easy to predict the outcome out of the next few hours or the next few days. As soon as you start stretching out, it becomes very difficult. I showed you this slide a bit earlier on in another video just to show you just how between 3-month investments here and long-term investments, generally the curve is sloping upwards, meaning that the longer the investment term is, the more risk there's associated, the higher the return will be. So let's look at a way to calculate and to identify some of this risk and to put a number onto it. So let's start from this top line up here. We're going to analyze a 10-year issue. We're going to analyze a bond that has a 10-year maturity date. And we're going to compare it here. Government of Canada 3-month issue, AAA rating. This is a short-term issue from the Canadian government, and this issue is giving me 2.91% return. We're going to call this the risk-free rate. Why do we call it risk-free? Well, first of all, the issuer is a pretty good issuer. We're pretty sure that the government of Canada will not default, that they will be paying the interest and paying back the capital inside of a 3-month period. We can determine that a short-term issue coming from a good emitter like the government of Canada is pretty much risk-free. That is the littlest risk we can take, and that gives me a 2.91 return. As compared to my 10-year issue, government of Canada, we have a 5.16 return. So if I subtract from this the risk-free rate, 2.91, I'll obtain 2.25. In other words, this additional 2.25% is charged to this issuer, government, because of only one thing, the difference between the 10-year issue and the 3-month issue. So maturity risk, we're going to call this the risk for the extra 10 years and 9 months. For that extra long period, 2.25% is the risk. So we've already figured out here a way to identify short-term, risk-free, and longer term. So there's a premium of 2.25 that's being charged. Now let's look at the following line. We have another issuer, provincial. Instead of AAA, we have 1A. So the quality of the issuer is a bit less. And as you can see, between these two 10-year issues, 5.16, 5.55. So let's just say that the 2.91 is still the risk-free rate. 2.25, it's the addition between the 3-month and the long term, just illustrated this here. Once we subtract these two amounts from my 5.55, you still have a 0.39. That is the default risk. That's the premium associated with the issuer. If I bring it down to a corporate bond, same thing. We have 4 different bonds here, different issuers, different ratings. You'll notice I'm always doing the same thing. I'm always subtracting the risk-free. I'm always subtracting that maturity because all these issues are 10 years long. The default risk grows to 0.9 here. Another issuer here, we're at 1.15. A third issuer with a lower credit rating here grows to 1.4. Into an even lower rating, you'll notice we're up to 3.72. This is the actual premium that's being asked by the investor to the corporate or to the government issuer in order to satisfy this extra risk. So we said earlier that risk is the possibility of not obtaining what you were expecting. So let's redefine risk as variability. We know, analyzing large historical data, what the average return of a security would be. Let's analyze the actual returns on a day-to-day basis compared to this average return. High-risk securities will be those showing that the average, that the individual observations can vary very widely from the average. Low risk would show that the actual returns on a day-to-day basis are very close to the actual return, to the average return. In other words, let's look at this statistically. We're going to analyze our return from a single share as a random variable. A random variable showing in a distribution of probability. So in this slide, what we're looking at, we have the average return here in the middle, and we have the return shown as the distribution, a normal distribution, showing the number of times that the return has been different from the mean, positive or negative. In the blue line, we're showing here that the observations are very, very close to the average, to the expected return. So we have a low risk share here, or a low risk security, I might say. On the other hand, the red line here shows that we have a way larger distribution. We have shares here, or securities again, you might say, that have an expected return, but the actual returns observed vary very, very widely. They vary a lot from the expected return. So there's a lot more risk that at the time you do the transactions that you might hit maybe very high returns or maybe very low returns. In the first blue line, well, the risk is a lot more mitigated. So that's fine. That's one thing. How does variability of one share compare to all the others? Would we say that all the shares are all reacting the same way? Well, they don't. How do we compare this? Well, we're going to separate this movement. We're going to separate the movement into two parts. Market risk, the risk associated to each and every share. Politics, inflation, interest rates, wars, these will all affect all the industries in a particular area geographically. That's the market risk. Business-specific risk, well, as the name says, very specific to each particular business, each firm. Earning reports, unexpected deaths, labor disputes, shortage of raw material, different elements that will affect your particular business and not the rest of the industry. So market risk plus business risk will give me my total risk. How do I compare now my returns to the returns of a market? This metric is called beta. It's obtained by doing a linear regression between two variables, the dependent variable, so your shares return, and an independent variable, the market return. And we're going to try to figure out when the market return moves in a certain way, how does your share react? Does it react exactly like the market? Does it overreact or underreact? For this, in order to figure out what the market return is, we're going to use market indexes for a proxy. Just like the TSX composite index, that's the TSX return, the one that you hear about on the radio or on the television every day, that tells you general conditions about the Canadian market. Or we can go to more specific, like TSX Industrial Capped Index, which is an index taking only industrial companies, making a package of these shares and tracking the evolution of that price as a whole. So composite index composed of different industries across Canada, but regional. It's composed of these companies that are traded on the Canadian Toronto stock market. TSX Industrial, again, Canadian companies, Toronto Stock Exchange, but in a very specific field. This is what I did here. So this graph actually shows on the horizontal axis movements of the TSX in percentage. So day over day, what is the increase or decrease in value? On the second axis, we have the returns for Bombardier. Each point here, each dot, represents the intersection at one specific date of the return from the TSX and the return from Bombardier. In other words, in this case up here, we see that Bombardier had a very high return on that day, while as the TSX had a negative return. Here, on this quadrant up here, we seem to be moving in the same direction. We have TSX moving forward from 1 to 3%, and you have Bombardier's shares also moving on the positive return. Down here, the inverse index going down, also Bombardier going down. So we can see that most of our dots are represented in these two quadrants. The opposite ones here is saying, well, Bombardier went down while the whole market was going up, or reversed. The line that we see here is just a trend line. So using Excel, we've plotted this graph and used Excel to generate a trend line. And we're looking here at the equation. What we actually did here is a linear regression. We're trying to figure out, is there a relationship between the evolution of one series of data and the evolution of the other? The first number we have up here is the slope of this. If we have a slope of 1, this would mean that for every movement of 1 in the TSX, we have an equivalent movement of 1 for Bombardier. You see that they're very, very close. And visually, we can see that most of our observations are in these two quadrants. This is what beta does. It measures a share's variation in return compared to the market. A slope that's equal to 1 will show similar movements between the two. A slope that is smaller than 1, between 0 and 1. A movement that is less for the share than the market. In other words, it doesn't move as fast as the market. If the market goes very, very positive, your share will move positively, but in a much smaller fashion. On the other side, if the market goes down dramatically, your share does not seem to react at the same speed. A slope that is bigger than 1, more movement in the share return than the market return. A negative slope, and this is very, very, very rare, means that for a movement of the market going into either positive or negative returns, your security seems to move in the reverse position. It counteracts. Beta does not measure business-specific risk. It really measures how does your risk, how does your share or your security's return move as compared to markets. So the first step I've already pre-done. I've downloaded from the internet the values historically for the last 2 years, day by day, for three things. The share. I'm going to analyze Bombardier right now. So this is the data. When I download it, you'll always have open, high, low, and close. This is the opening value, the high it reached during the day, the low it reached during the day, and the close value. So we're going to use the close value. This is at the end of each day. What was the closing price? I've done the same thing for the TSX composite index, so all of the TSX shares, and TSX Industrial. Why did I use TSX Industrial? Because Bombardier is included inside of this index. It's an industrial type corporation. It isn't working into finance. It doesn't work into these other industries. It's really an industrial sector manufacturer. So this is a more precise look at what different companies inside of this market are doing. The second thing I did, I just used this line, these two columns here, date and close, to generate these graphs. So we can see the evolution of the price of the share during the last 2 years. We did the same thing with the TSX, and I did the same thing for the TSX Industrial. Visually, I wanted to see all three of them together. So what I decided to do, because these are on very, very different scales. You'll notice here TSX in the 100 to 180 range. TSX Composite, we're in the 600 range. In Bombardier, we're in the $4 to $5 range. If I put all these three on the same graph, they would not really look interesting. It'd be very hard to compare them all. So I modified a little bit. And I did this here. I called it the TSX Adjust Bombardier. I just called it that way. What I did is I readjusted the close value for the TSX to be equal to something from Bombardier. In other words, what I did here is I just divided my value here, 710, by itself, which gave me 1, and multiplied it by the value for Bombardier at the same date, giving me, of course, the Bombardier value at that date, $4.10. On the next date observation, I looked at the progression on the TSX. E492 divided by E493. I applied the same progression to my $4.10. In other words, if I had invested $4.10 in the TSX on that particular day, or invested $4.10 in Bombardier, I would have one share of Bombardier, and I would have a fraction of the TSX. Bombardier would have moved in a certain way. My partial share in the TSX would have gone down to $4.09. The difference between these two, as a percentage, applied to the 410. And I did this over and over for each period. I did exactly the same thing for TSX Industrial. Why did I do that? You'll see this in this next chart down here. All of these three lines represent the first blue line down here, the closing price for Bombardier. The orange line, the TSX, starting at $4.10 also, and showing its progression. So if I would invest, so now I can see that Bombardier actually seemed to follow the TSX at this point, had a bigger increase, then decrease, followed by a slump here, went back up to the levels of TSX, and then outperformed TSX at this period, and right now, it's underperforming. Same thing I could do with the gray line up here showing TSX Industrial, showing that if I had put $4.10 into these shares, I would have a better performance than what I'm getting from Bombardier, or what I've gotten from the whole TSX. Okay? So this is just a way of visually seeing what we're trying to interpret here. So I'll show you my calculation. Very, very simple. I'm just looking at the close price. I'm just looking at capital gain between two different periods, exactly what we saw earlier in other calculations, and I did this over and over on a daily basis. Just looking at the evolution of the share price. I did exactly the same thing for TSX and for TSX Industrial, and I just brought them back into the same sheet here. TSX being my independent variable, Bombardier being my dependent variable. That's why you need to put them in this way so Excel will plot them correctly. Your independent variable first, which will be your X, and Y being Bombardier is returned. Selecting these two sets of data, I just went into the insert and chose here the scatter plot. Scatter plot, what this does, it will plot these two values. This is your X, this is your Y, and will generate this plot. Once your plot has been done, all that you have to do, I think you've done this in other courses, all we want to do is add a trend line here and display the equation on the chart. This will actually draw this line that we see here and display my equation. The slope of this line in my linear equation is the factor coming before my X. So we have here 1.0018. In other words, for every movement of X, we have an evolution of Y of roughly 1. In other words, Bombardier seems to be moving in the same direction, in the same amplitude than the market. I did exactly the same thing here, but rather than use the TSX composite, I looked at Bombardier compared to its industrial sector, the TSX Industrial Capped Index. We're seeing here 1.09. We're seeing a slightly more variance from Bombardier than the rest of the industrial sector. What does this tell me? Well, in general, we're moving a little bit more than the industrial, so there are other companies in there that are more stable than we are. Compared to the whole market, we're moving in the same direction, so we have no more risk than general market risk. So this is how we go about calculating this beta.